Okay, hello everybody. Welcome to Selfwealth Live, the technical analysis edition here with Jason McIntosh on to my left, and myself, Roger. I work for Selfwealth. Hey, Jace, how are you today?
Hey, Rog, I'm good. Good to be back on the show. Good to be back live because, of course, we were pre-recorded last week. So it's always good to be live. We can do those stock codes and engage with the viewers. And so, yeah, it should be fun.
It is good. Now, I don't, as you, as we already know, we won't talk about the weekend because I know you're a Sydney fan. We'll move straight on from that. But it was a good win from the Maroons. I was about to call them the Maroons, the Brisbane Bears or the Brisbane Lions, whatever you want to call them these days. So, and let's move on from that. Hey, shall we, Jace?
Yeah, there are days to talk about these things and days just to go. Let's move.
Let's move on. Well, I hope everyone who may be on this call from Sydney or go for Sydney, I hope they're feeling all right and over the hangover. And same for Brisbane, obviously from the weekend. Good on them. All right. So before we get moving, Jace, we're going to go on with our regular affair. Good to be back live, as you said. Last week we had a replay session. I hope people got something out of it, where we pre-recorded the session and then showed it at Tuesday at 12 o'clock. Today we're back live, so please, the way we format this, if you've never been, is we will go through the ASX market, we'll go through the US markets, and we'll go through the Hong Kong market in general, have a look what they're looking like from a technical perspective. A lot happening, obviously, especially over in it with the Hong Kong and Chinese market, which is good to see. And then what we'll do is, if you've got any sort of general questions, then feel free to pop them in the live chat here. And then we'll also analyze your tickers, any tickers that you want us to have a look from a technical perspective. Once again, feel free to pop them in the chat, and we will have a look as we do. All right, Jace, did you want to show us the disclaimer for today, please?
Yeah. So as always, everything today is general commentary only. No personal advice. And I'll just quickly put up our disclaimer. That just goes through all that. And the other important point to note is that I'm not part of Selfwealth. My business is Motion Trader. So you can see my details at the top, licensing, etc. And beneath that, you will see all the Selfwealth details. So, yeah, there we go, Rog. General commentary only.
Thank you very much for that. Obviously, anything we do or say on this show, make sure you do your own due diligence around it. As Jay said, it's all general in nature. Now, I thought before we get on, I was starting, getting a bit itchy around, wanting to learn some stuff. And it's funny because only a few weeks ago, we talked about not overcomplicating things and not wanting to learn too much. But I was at the library with my son a month ago, and I decided I'll see what stock trading books there are at the Geelong Library down here, and I picked up this book here, and I'm not sure if you heard of it, the Ulysses Contract. I don't know if I've said that correct.
No, I don't know that one.
Camp. But I wanted to bring this up just because of this line right here. And I don't know if you can read this here. I don't know if anyone on the show has read this book, but it's starting to be a good book. Obviously, it's not about technical analysis, but about the share market in general. But the reason why I bring it up, I should credit the author as well, Michael Kemp. The reason why I bring it up is because it says how to never worry about the share market again. All right, that's the sort of byline there of this book. To which I told my colleague this yesterday. I was reading this book, and he said, "Well, that should be a pretty short book. He just said, just never invest in the stock market." That's how you never worry about the share market ever again, right? So, but it's a great book for if anyone wants to read. Now, the Ulysses Contract is the story behind this is really good because it's pertinent to a lot of the things that we go through as investors and share traders, right? And it's all about, it's kind of like putting your blinkers on from all the distractions there are in the world. And the story goes that there was the Ulysses, who was the leader of the ship, with all his men who were rowing the ship. He would put blinkers on their men So they don't. So basically, they don't go towards the islands where there were sirens. All right. Now, obviously, sirens are very attractive. They didn't. They were to go the direct way, the direct path to whatever it was, the victory they had to do, without getting distracted and going off to visit the siren. So they put the blinkers on, and they had a contract to make sure they kept on going. That's the sort of general nature of the story. And how relevant is that to what we do in the share market, right? How many times do we have to sort of stop ourselves from doing something else, almost have a contract with ourselves to make sure we're sticking to our trading plan, Jason?
Yeah, it's about having the discipline to follow your process, to not look around, not be lured into other indicators or what other people might be saying. Not looking for the person to support what you're thinking, but just trying to have your a rules-based process that you can follow. And that's like putting the blinkers on, in a sense. So it's a really, really interesting way to analogize it and look at it like that.
Yeah, no, I think it's a great way. And I think one of the things I learned a while ago, if you want to try and, as I'm getting better to try and sticking to the rules, and all of a sudden I'm starting to see my portfolio doing great things at the moment. It's about writing down a contract with yourself, saying, hey, I'm going to stick to these rules. If I decide that if I look like I'm going to stray, I've got to work out a way to go back, to bring myself to the original plan, and having a contract with yourself as well, right? So even if you have to put it down in pen and paper, that could be a strategy, right? To have a contract with yourself, right? So, but anyway, I thought I might open up on that bit of as you say, it's an analogy or philosophy around the share market, right? So,
and I think it's good, because what a contract does, a contract says this is how the agreement's going to work. We're going to do this, and if this happens, we're going to do that. That's exactly what a trading plan is all about. It's like, we don't know what's going to happen next, but if we've got that process mapped out and written out, we know what we're going to do, regardless of what the market does. If it goes up, well, we're going to do this. If it goes down, we're going to do that. So it's all laid out. So that takes away a lot of. I think the thing with the stock market that keeps most people up at night, it's the uncertainty about what's going to happen next. And I think having a plan, it doesn't take the uncertainty away completely, but it does take away the uncertainty to an extent, because you know what you're going to do regardless of what happens. And that can help you stay in the game when things get difficult. Like, there've been some difficult years of late, and just having that game plan that you follow, you go, okay, I know it's difficult, but these periods do happen. So I stick to my process. I keep following my rules best I can, keep my blinkers on, and invariably come out the other side.
Exactly, and watch out watch out for those sirens. All right, fantastic. Let's move on then. All right, let's start off with the ASX market. Not doing much today. How are we going over the week, Jace?
Okay, so let's click over to the charts, and so the first chart here is the ASX 200, new all-time high yesterday, which is always of interest. I'm not going to start with the ASX 200 today. I'm going to come back to this in a moment, because I think there's more interest elsewhere in the ASX. Mm-hmm. And that interest is with the ASX 200 equal weight. So we do look at this sometimes, the equal weight. So the difference between the two is, so the ASX 200 is market capitalization weighted. So the biggest stock will have the biggest weighting. So BHP is something like roughly 10% of the market. And then you've got the banks in there. CBA, I think, might be next, and then the banks and Rio's in there. And so those big stocks make up like maybe about a quarter of the market. When you look at the ASX 200 equal weight, the larger stock and the smaller stock in that grouping have the same weighting. So if BHP goes up a lot one day, it's just one of 200 stocks. It's not going to have that bigger pull on the equal weight index. So it's an interesting one to look at. And so what's been so significant with this is this breakout that we've had in the last few days. So this is breaking out of a 6-month trading range. So let me just put this range on. and the range looks something like that. So it goes back to March, the March high. And so we've had this choppy, sideways, meandering range for about 6 months. Had a couple of false breaks in August. So we had a break to the top side briefly, and then we had a brief break to the downside. Neither of those breaks gained momentum, back into the middle of the range, and now we've got another breakout in the last week. And to me, I think this breakout, I think this is the real thing. And I say that because it's not just a gentle nudge outside the range like we saw in August, but this is a powerful breakout. And just look at the rally off the September low. So coming to the September low, the 9th of September was the low. This has been, the equal weight is up 8.7% to yesterday's high. It's up 8.7% in just 16 trading days, so about 3 weeks. In that same period, the ASX 200 is only up about 5%. So we've got this relative strength playing out in the equal weight. This is why I think it's so significant. And I think the relative strength in the equal weight is a sign of broad-based buying across the top 200. So this is not just a BHP or a CBA story, but to get this breakout in the equal weight, you've got to have that broad participation. And I think that's positive for the market generally, because a healthy market should have that wide participation. And I think that's what this breakout is telling us. And just zooming this out a little bit, having a little bit more closer look at the detail. Let me just compress it for a bit first so we can sort of see where everything sits. There's the low, the depths of COVID. Then we had the great rally. We had the correction. This difficult period where we want to keep our blinkers on and just have our plan. And then it's this low point I want to focus on now. The low from October last year. So just I was just zooming this back in on the price action. And you can see how the structure changes. So we go from this period where price is below declining moving averages, and then we get the flip. We get the flip where price goes from below the averages to above. Moving averages cross. We start getting prices trending higher, butted up against this overhead resistance. You can see the resistance with some previous peaks. Broke above that. That took us into that April high. And then, as we've discussed, that trading range, which has kept prices in check for the last 6 months. And what I like about the last 6 months is that prices have just sat on top of that old resistance, which became support. So that was always been a sign that there's been buying underpinning the market, which is something we want to see when prices are consolidating, and just the choppy sideways nature of it. I look at this, and this is your classic. I think this is your classic platform building. So often we talk about a base. Talk about a base when a market has been falling and it bottoms out, forms a base. Once a market's been rallying and the structure changes from bearish to bullish above the moving averages, it's more, for me, I'd call it more of a platform than a base. So a platform gets established, and then from a platform, another rally can start, and we can get another period of rising prices. Another building phase gets underway. So that's where I think we are now. Now, we often get pullbacks after these breakouts. Pullbacks allows the market to consolidate the initial advance. So I don't think we should be surprised if we get a bit of near-term weakness over the next week or two. This has been a strong, unchecked run. Like 8.7% in 3 weeks. That's pretty strong. We maybe it doesn't pause for too long. It's just something to be aware of. Don't be surprised if we do get some sort of a near-term pullback. But overall, Rog, I think the path of least resistance is upwards, and I think the equal weight is likely to head back towards this all-time high from January 22. Coming across to the ASX 200. Back where we started, just quickly having a look at this. Nothing's changed from what we talked about last week. It's still a case of a bullish structure. Prices above these rising moving averages. I've got the 50 and the 100-day moving averages, and I believe the play continues to be approaching this market from the long side as always, I'm using those wide trailing stops that I often talk about to see off any pullbacks for the inevitable pullbacks which occur. And of course, the trailing stops, they also get me out when conditions change and the market goes into reverse. So I think they're a really important part of risk management and staying on trends while they're active, and then getting you off trends when they start to break down.
Yep, very good. Well, it's great to see, obviously, that it's not just those top 200. And I wonder, top 200 that's carrying this bull run at the moment. But let's have a look at the American one, because once again, to Kirby's point, it's good to see that there's a lot of rotation going into those small caps. Is it a similar thing happening in America?
Yeah, and the small caps are another story. So we were just looking at the ASX 200 equal weight. The small caps exist below the top 200 as well. So there's interesting things going on in the small ordinaries, in the emerging companies index. So it's really broad-based across the ASX at the moment. Looking at the S&P 500, well, it's another all-time high. Just pushing that out a bit. That was on Thursday. It was another all-time high. That was actually the 42nd all-time high for this year in the S&P 500. And that's pretty amazing, really, isn't it? 42 all-time highs. And I think when I say that, a lot of people might think, wow, that sounds a bit extreme, 42 all-time highs. That's something I don't know whether I'm comfortable with. But look, and this is the thing, yes, it is a lot, and it does sound extreme, but when you actually look at the history, you look at the data over time, it's not as extreme as you think. So the most all-time highs in a year for the S&P 500 was back in 1995. So let's just go back. Let's quickly see if we can go back to 95. It was back here. There's 1995. There were 75. So we're talking about 42 now. In 1995, there were 75 all-time highs in the year. So that's the record. Now you might be wondering, well, okay, that's all well and good. What happened the next year? Surely the market had to go down, but it didn't. The run continued, and the next year it made 39 all-time highs. The year after that, it was 45 all-time highs, and then this continued for several years, as you can see as we scroll through the chart, until it eventually peaked in actually that's not the peak either. Along we go some more. Like, this is the thing with trends, isn't it? Eventually peaked in 2000. So I'm not suggesting that's what we're going to see now. It's just to say that don't get too frazzled when you hear 42 all-time highs, because there are periods in history where that can well and truly continue for some time. Doesn't mean it will, just means it can. And this is the thing with all-time highs. We get clusters of them because that's how trends work. A series of all-time highs doesn't warn of a top. It tells us that the market is in an uptrend. So it's probably counterintuitive to how a lot of people would look at it. A lot of people would say, I'd like to buy the market at a 12-month low, not a 12-month high. But the odds favour buying the 12-month high, buying the series of rising prices. So yes, every trend's going to ultimately end, and there are going to be corrections along the way. But the data is currently telling us that the path of least resistance in the S&P 500 remains to the upside. Just looking at this chart structure, 50-day moving average, 100-day moving average, both are still rising. Prices above the moving averages. We've also got a long series of rising lows, rising highs. So these are all things that we use to define bullish price action. There's always room for pauses and consolidations, but I think at this stage, Rog, it's there's nothing here that should sway us from the game plan of being long equities. Quickly going over to the equal weight version of the S&P 500, because of course there's an equal weight version of this as well. I actually prefer this chart. This is my preferred measure of where the market is at the moment. S&P 500, of course, is never to be overlooked. But I think the difficulty with the S&P 500 at this point in time is that the top three companies, so this is the S&P 500, the top three companies top 3 companies make up 20% of the index. If you push it out to the top 15 companies, they make up 40% of the index. So that's a lot of influence in a handful of stocks, and I think it can make it harder to assess performance of the broader market. So the equal weight, of course, doesn't have that issue. So let's just go back across to the equal weight, because as we explained with the ASX equal weight, everything's ranked equally. Microsoft and Nvidia and Apple, they're weighted the same as stock number 497, 98, 99, 500. So what does this chart tell us? I think unlike the S&P 500, which only just broke above its July high last week or the week before, let's just quickly go back. Just have a look at this. Just make a mental note of this. July high, market remained below there until a couple of weeks ago. It broke higher. Now let's go back to our equal weight. There's our July high. And look at this. There's a series of all-time highs over the last few months. So the equal weight has actually been stronger, and I think showing signs of that broad participation, which is a key factor in a healthy bull market, just like I was saying with the ASX. And of course, we've got those rising moving averages, prices above the moving averages. So I think rather than fear a series of all-time highs, I think it's a case of continuing to follow the trend. It doesn't guarantee we have success, but the trend is the path of least resistance. We still need to manage our risk, but I think the default position should be to stay long equities.
Yeah, I mean, look, it's hard to sort of, with all the doom and gloom that the economists talk about, cost of living and all that, it's just contrary to what's going on in the share market. People still investing. People are putting a lot of money into the share market, very bullish on the economy and in general. And then obviously there's a point, Talon's point here, even the government's putting money out, more money, stimulus packages in China to get their share market going. So do you want to, we go flip over and have a look at the Hong Kong market now?
Yeah, we'll do that. Just before we jump over, it's interesting what you say about doom and gloom. There's always doom and gloom. Every year I've been in the market, there's always been doom and gloom about something, and it's just human nature. We're just always looking for trouble ahead. What was interesting this period down here around late 2022. I think it was a case that 100% of surveyed economists were looking for a recession. I think they were saying, I think it was like a recession is 100% certainty over the next 12 months. But of course, the market bottomed somewhere around there, and we've had this extraordinary bull market since. So I think we just got to be careful with predictions, because predictions about the future are notoriously difficult, and they're often wrong. I don't make predictions because I don't know what the future is going to be. I look at trends and say the path of least resistance is up and probability favours being long. Doesn't mean that's how it's going to play out, but I'm going with the flow. I'm not trying to predict what's going to happen. Whereas, when someone says there's 100% certainty of a recession, that's a clear-cut prediction about what's going to happen in the future. Yeah. So, and that hasn't played out that way. So if you invested your portfolio based on the certainty of so many economists about a recession, you would have been out of the market, and you would have almost certainly missed most of this rise we've had in equities over the last, coming up to 2 years now. Well, this is actually October 2022. So 2 years. We have 2 years of rising prices. So, of course, all due respect to all economists who analyse markets and everything, it's not to be downbeat on that. It's to be downbeat against people who are extreme in their outlook. Say, something's going to fall 90% or it's going to triple. I think they're to be treated with complete caution and scepticism. But an economist going, that's their job. Their job is to forecast, but we've just got to be careful when it comes to investing around prediction of the future, because the future is difficult. So I prefer to look at the price action. Sure, take everything on board, but you take on too many predictions on board, you can also get yourself scared out of the market when the price action is telling us something different. So
that's right. And I mean, this is the perfect example coming up. Let's have a look at because from 1 week, last week, we wouldn't even look at this market to this week, just what one announcement can make and do, and no one saw it coming, right?
Yeah, and that includes me. I didn't see this coming for a moment. My comments last week were these markets, Hang Seng and China, I said they were just best avoid it. There's just nothing to do here until we get clearer price action. It looked to me that the Hang Seng was just oscillating either side of the moving averages. These things are going to happen. To me, it looked like it was a low probability event that we were going to get a sharp move higher. The probability seemed to favour just more chop with vulnerability at the downside, given what was happening in China. But look, these things happen, and what we think is probable or likely often doesn't play out. Just like we were talking about with recessions a couple of years ago, what a lot of people thought was beyond likely, almost certain, didn't play out. So we don't know. We just don't know. We've got to look for setups and try and play them as best we can. And some of them we're not going to catch. Now the key driver here has been China. So let's jump over to that and focus on that for today. And this really has been extraordinary. You just like step back and put it all into perspective. We've had this ongoing decline, and now we've just got this absolutely turn on a coin reversal. Just blowing this out a little bit, just zooming in a little bit. The only clue we had a key reversal day on Thursday a couple of weeks ago. But then, having said that, we also had a key reversal in August, and we had a key reversal in July, and neither of those played out into anything. So it was really just like, you look with hindsight and you go, there was a clue. But to play that clue, given the history of how this had gone, and to go against the general decline with prices below moving averages, it was a low. I'd say that would have been a low probability call. Sometimes low probability calls get up. Long shots. 100-1 Bolter can win the Melbourne Cup, but they usually won't. So, I think it's playing the outliers is most of the time we lose. So I don't play them. But then, look, occasionally you get these moves. Other bull markets have started with these sharp moves. So look, the possibility of an ongoing bull market is certainly there. So we can just go back a bit, and you can see some of these sharp moves in the past have led to ongoing strength. So it's going to be interesting to see how this plays out. I'm hesitant to chase it at this point in time with it having run so quickly. I think there's also like holiday period in China for the next week. So not much is going to happen during that. I'd rather wait for the next consolidation, see what it looks like, make an assessment from there. And we can see we go back to, just quickly go over to 2020 and 2019. So here's 2020 where we had an equally impressive rally, but then we got the consolidation back to the moving averages. And we saw something similar in 2019. You got this strong lift-off period, and then we got the consolidation back to the moving averages. So these markets do pause to consolidate. They're just not going to keep taking off like a Saturn V rocket, go into orbit. Doesn't work like that. You get the consolidations. We've got this overhead resistance that comes in. You can see this resistance has been a key point. That's not too far from the market. So probably maybe this is going to settle down a bit over the next few weeks. If we get some consolidation, we can then talk about that. Maybe this turns into something. At the moment, I'm playing this through the rallies in some of my ASX holdings. Like some of my mining-orientated holdings have done really well in the last week, and that's most likely off the back of this. So I'm participating in a different way, but not through, didn't see this one, not participating through the Chinese market at this point.
It's a good way to look at it. Once again, obviously, a lot of companies in Australia will run off Chinese news as well, or things going well over there. So it's a good way to look at it and saying, hey, yep, you've probably got companies that have got involvement with other Chinese business and companies, right? So, but I think what really happened, Jason, is the government were listening to you last week, being all bearish on China, and look what they did, mate. So look what they did.
There you go. And there's also a lot of short covering. going on as well. So when you get a market which has been trending down for so long, it will naturally attract a lot of shorts. People who follow trends and trade short will short the market. So there's also what we call a short squeeze going on in this as well. I think this is a market which globally is generally very underweight. Global investors would be generally underweight the Chinese market. So as well as shorts covering, maybe there's some rotation to reduce that underweightness, but that's something which could play out over quite a while if this gains traction. So certainly further upside potential on this over the months ahead. But as I say, I'd like to wait for that consolidation and see what it looks like. Is the initial dip from wherever the high ends up being formed, is that initial dip going to be bought? Will it be buy the dip? Will it be buying underpinning the market as it consolidates? That's the sort of stuff we want to see. And then we can say, okay, right, looks like it's finding support. We can now buy a breakout, or we can buy a dip back to moving averages. But all that's probably going to take a little bit of time now to play out.
Yeah, it's good though that we get to see this play out over time as we analyse it week on week, right? So it's a good situation to have for our educational series here. So, all right, well, let's have there's a bit of a general, before we get onto tickers, let's just get onto this general question here around, and it's a pretty simple one in a sense that I reckon we could just it won't take too long to answer this. How do we know when reversals are happening? What indicators do you look at, Jason?
We never know. We never know for sure. Like we can look at this period from the October 22 low. What looked like could have been a reversal didn't play out. It peaked and then it fell and it made a new low. But it had, like, if we looked at this at the time, what I would have told you at the time would have been, we've gone from below the moving averages to above. We've consolidated along the moving averages. We've rallied again. The moving averages have crossed. We do have overhead resistance ahead, but this is looking encouraging. Could potentially buy a position with a stop below the 100-day moving average. So it looked like there was a possible reversal. But when I speak, I'm always speaking in terms of possibilities, not this is going to happen, because we don't know. We only know when we look back what has happened. And when we look back on this one, it didn't play out. Market stalled, got back below the averages, and continued lower. So the key things I'm looking at the price relative to the moving averages, and I want to play when the price is above rising moving averages. If we get a consolidation back to the moving averages after initial rally, that can provide a great entry opportunity. But again, we just never know. I may look at an RSI sometimes. Is there some divergence on the RSI? But I'm not a big indicator follower. I like to keep it simple, and price and moving averages, I think of and new highs. Price, moving averages, and breaks to new highs. I think they're some of the best indicators we can use. So look, that's how I'd play it. And I also play it on the basis that we were always prepared to be wrong. It's really important. I think every time we take a position, we should always be thinking, okay, I'm taking a position well and good, but what if I'm wrong? I've got to prepare to be wrong. Where's my stop loss? How much am I possibly going to lose on this? Is that acceptable? Is my risk acceptable to my possible upside? But everything's possible. Nothing's certain. And for me, I don't want to try and pick lows. Picking lows is notoriously difficult. Somebody probably did pick the low in the Chinese market, and good for them. But there have been plenty of other attempts to pick lows which have fallen flat, and the steamroller goes over the top, because that's what the trend normally does. The trend normally extends. So it's about not fighting trends. It's about participating in what could be a potentially emerging trend. I'm also using slower moving averages. Some people like to use, say, 10 and 20 days or some other combination, and you're going to get more turning points and you can be more active. Depends what you like. If you've got the time and the focus to be more active, yeah, sure. Have a look at a 10 and 20 day moving average. Just be more You're going to have more false breaks, more false signals. That's okay because you can manage them with stop losses. But then you're going to be in some of these trends earlier. Mind you, a 10 and 20-day moving average wouldn't have caught this one either. That was that was just out of the box.
Yeah, and just to add to your the way you do it, Jason. I mean, for me, what I've learned over time, and even if you look at that graph, obviously this theory wouldn't have picked up this move that happened last week either. But even before the moving averages cross, for me, I like looking at the patterns that get formed, right? And I know we've spoken about this in the previous series on how to look for double tops and double bottoms or head and shoulder patterns. I know you don't look at it that much, but maybe I can sort of identify double bottoms, and see where before the moving average is across and just looking at that chart because I've got this chart eye. But is there something that you wanted to elaborate on?
I'll look at general patterns, and I'll often talk about in the weekly strategy sessions. And when we catch up, if there's an interesting pattern like a head and shoulders or a double bottom, I'll typically bring attention to it. But they're not the primary way that I'll take a position anymore. There may be one factor to consider, but for me, the key factors are where are the moving averages, where's the price, and is the price making a new high, or is it pulled back to rising moving averages, and maybe it's a buy the dip opportunity. It's that key overall structure of price and moving averages, which is number one for me. But there's nothing wrong with looking for some patterns. That's my original training. My original training was looking for patterns in like the wedges and triangles and trading ranges and pennants, all these funny names we have for these things, but they're interesting, and they can, if you do them well, they can certainly add to your process.
Yeah, and like you said, I don't think I do them as a way to trade off, but I do it as a way to be able to see if there's a potential reversal about to happen, right? So just to look out for it, and then use the confirmation of the EMAs and the price action above or below the EMAs as well, right? So,
so the example of a reversal which I was watching, which I didn't take a position in, was lithium. So the lithium ETF, I was watching this because there was. So, like, this is how I might use some indicators. So I looked at the RSI, and we had the bullish divergence. You can see the lows in the RSI are getting higher, but the price in this lithium ETF is listed in the US. Price was getting lower, but wasn't being confirmed by the RSI. And then I like this gap higher, and then this sideways consolidation. It looked like a bullish flagging pattern. So you can draw the lines on it. So I was looking at this and I was thinking, do I want to jump in ahead of the moving averages and play this? And I didn't do that. What I did instead, I found a pattern. I found a stock which has similar correlations, but structurally looked better. It was Linus, LYC. I spoke about this in my strategy session video a couple of Fridays ago. And I preferred this play to lithium because the lithium ETF, because the price had already flipped from below the averages to above, the averages had crossed, and then we had this sideways consolidation back towards the averages. So I bought some of this just as the price was breaking higher. I considered buying the dip back to the averages, but I didn't. Could have managed the risk quite nicely on that, but it's like there's variations to how you can do things. I bought the breakout, and so far that's been playing out well. If we see that lithium rally continue and rare earths continue to rally, well, then we probably see a stock like Linus would probably continue to rally as well. And for those who chart eye, we're talking about that. Here's can you spot the head and shoulders? There's your shoulder, there's the head, there's the shoulder, and we could also call this a rounding basing pattern. So lower lows, final low, and then rising lows. So there's always these interesting little things that you can look at, maybe to give you added confidence in that structure, which I like, with price being above the moving averages.
All right, fantastic. All right, let's. I hope that answered your question there. Let's have a look at a few stocks now. There's quite a few come through. So let's start off with Kirby's TLX, please. Sorry, Macoose, I don't know if White Rabbits is a company, but let me know if it is, or what that was referring to.
White Rabbits, okay. I
It's
don't
not
know
the team
that.
that's in the NRL grand final this week, is it? Or against Melbourne? I don't know, against Melbourne.
The bunnies are gone, so it's not that.
Obviously, go to swing.
Yeah, look, there's not. I like the structure. We've got this clear uptrend, but then we've had the pause, we had the consolidation. I like that. You've got this. You can actually draw the lines around this. You call that like a wedging type structure, where the markets run into a high, and then we've got the sideways consolidation back to the averages, and we've got the breakout. Now we're getting the consolidation of the breakout. So if I had this stock, I'd certainly be continuing to hold it, let the profits run. It is a motion trader stock. It's been there for some time, and if I didn't have this stock, would I buy it? It's like I much prefer getting these ones earlier on when they're just breaking out. I do struggle to buy some of them after they've run for a while, but that's just me, because these things can just keep, these stocks can keep running. You just don't know. We don't know. We do not know whether the high is near or whether it's going to double again from here. But from an entry perspective, it could be bought at current levels, and a stop could be placed. So like looking at this previous range, so we'd want to get back within maybe this low point from September, and also the 100-day moving average. So maybe it could be bought with like a 17% stop loss. So if it gets back down 17%, well, you'd say, well, look, the breakout's failed, it's lost its momentum. Who knows what happens? Does it then start to continue lower, or does it stabilize and go sideways for a few more months? Don't know, but I'd probably jump out at that point and say my reason for buying is no longer valid, and let it go. So it's just an example where we've got an uptrend. It could be held, or it could be bought, and risk can be managed in a reasonable way where I think it's still asymmetric to the upside.
All right, fantastic. What about LRK?
Lark. This was I had this stock a while ago. It was a motion trader stock. It was one of my standout trades. So I've actually got the lines drawn on it. So this is how I like to play it. So there was the motion trader signal must be around. There's the cross. Motion trader signal must have been on the initial surge. I've probably bought this pullback back towards the averages, and then it was a case of let profits run, and it went from, where's that, $1 to, there's my exit point here, to a touch over $4. So really, really nice trade. It hit a trailing stop. So I got out, and this is why we have exit strategies, because look what's happened since. It's just continued to unravel, and it's actually fallen below my initial entry point. So some people just hold and they give back all their gains plus some. So exit strategy, I just can't emphasize how important having a plan for selling is. We don't make our money when we buy, we make it when we sell. But everyone's scurrying around, looking for the next buying tip. How often do you see someone talk about giving a tip for when to sell? It's like it's all so much focus on when to buy, but buying's all great, but unless you've got that plan to sell, it can just be a disaster. So I just can't say enough. Really have a good think about a structured process for selling, not just I think it's gone far enough, or it's coming back from the highs, maybe I'll lock it in now. Have a structured process, rules-based. I think that makes it consistent over time. Now, I diverged a little bit from the question. What would I do with this now? I'd still leave it alone. If the moving averages are, they're starting to turn higher, but the problem now, this is a sort of stock which then could just chop sideways for years and just never do anything again. maybe the magic won't be repeated. It could be, but it definitely may not be. So it's too early for me to run with this. It does have a rising lows, so maybe it is building up for a bit of a punch higher. It could be. Like if somebody really liked it, they've gone away and for whatever reason, I think, look, this is a stock I want to be involved with. It could be bought here and risk can be managed. Like look at where the current price is, and you look at these previous lows. Like pick one of these lows to sit beneath for a stop. Maybe it's the low from August that is something like 17% away, or the low from later August. Then maybe it's about 12% away. So you could also possibly say this is you can almost say this is an ascending triangle, which is a little technical pattern. And the theory with the ascending triangle is that the buyers are becoming more aggressive in getting on board. So every time it dips, the buyers step up their buying and they raise their bids. And then the selling is pretty much fixed around a certain level. And then ultimately the theory goes that the buyers will overrun the sellers and then the price will pop higher. That's the theory. Sometimes it works out. So you can build an asymmetric play around this in that you could even do this with use Friday's low. It probably doesn't have a whole lot of liquidity for jumping in and out, though. That would be the thing to keep in mind. Maybe you could do it on an 8% stop loss, but then be prepared maybe for a bit of slippage. There's a play there. There's certainly a play there. Not for me. I'd rather wait for the averages and stuff to turn higher. But it's an interesting one to watch. I wouldn't rule out some potential in it.
All right, let's have a look at APX to start off with. Target price, we don't know, but trailing stop and key support and resistance levels, if that's okay.
Yeah, I don't do target prices because no one knows. And this is the thing with the trend. A trend can go further and last longer than just about anyone can anticipate. Like who would have thought Lark would have gone from $1 to $5? Probably not too many people at the time. So this is the thing. But if you have a price target, this is a thing with a lot of broker reports I'll see. Might say, this stock's a buy at $1 and we've got a price target of $1.30. It's like, well, that's where's my risk on this? I'm punting for playing for a 30% possible upside, and I might need to risk 20%. So I'm risking 20% to maybe make 30%. Doesn't work for me. I don't think that's a risk reward play. I want to look at a stock where I say, look, I think this stock could double. Doesn't mean it will double, but it could. And if it could double, and I can say I can get in this with maybe a 25% stop loss, maybe have a time exit if it's not working out. I go, yeah, this is asymmetric. My upside potential is considerably more than my likely downside risk. So that's where I want to play. With Appen, so look, upside target is open. Could this go back to the all-time high? It could. So that's not a target. It's just to say, upside is uncapped. There's no limit on the upside. And this is where you can make some of those super gains where you get stocks that go up 300%, 400, 500, even more. It does happen, and that's how I think you get them, leaving your upside uncapped, not focusing on a target. With this now, like the structure is great. It's running. It's above the rising moving averages. The tricky if I'm in this, I'm staying in it. I'm giving it plenty of room to move around. My stop would probably be back below the 100-day moving average. I'm giving it a whole lot of room to move around because I'm playing for the big win. I'm not playing for 100%. I'm playing for 1,000%. By the way, I haven't got a stock that's gone 1,000%. I've got a couple of 500s and some 400s. I haven't got 1,000 yet, but that's what I'm playing for. I'll see whether and at some point, if I keep playing this long enough, odds are I'll get one, but I'll get it by keeping the upside open. So that's why I risk giving back plenty to stay on board. I find it difficult to buy now simply because it's 63% back to the 100-day below the 100-day moving average. So where do you put your stop? It's too hard. Like this could now consolidate at some point, come back towards moving averages, even if it just goes sideways. It could come back 20, 25% and just be part of a big sideways consolidation. So it's hard. It's a tricky one to buy. So like the Chinese market, I'd rather wait for the next substantial consolidation and then think, look, is there now a point to get on board? But yeah, certainly I'll be letting profits run.
All right. What about the same on the DRO? Any support and resistance levels that we can identify? Key support resistance levels?
Okay, well, support's going to be around these lows. So we've got the low from late September, and we've got another low from mid-September. Like this. Yeah, look, I wouldn't be trading off this line at the moment, but it just shows there is a general series of there's a general tendency for the rising lows at the moment. So I'd say, look, we've got that support around these two previous lows. Seems to be trying to break higher at the moment. There's some upside potential here. It wouldn't be surprising to see this stock move back towards $2 from current levels. So from that perspective, you could say, look, buying at current levels, say it was to get to $2 as and this is something to bear in mind as well. So it's 40% to $2, and maybe you've got to have 20% of risk to get below the late September low, or 25% to get below the mid-September low. So we're going, okay, maybe 40% upside, maybe 25% downside. Is that an asymmetric setup? I'd say it's not really, because your upside potential, it's like, and I don't know, it's not, it could, maybe it makes a new all-time high, but it's often don't get that. We not, and not that soon after the previous high. Like once you have this complete clean out, it like you can put Fibonacci's on. This can be an interesting thing to do. I've seen this happen many times. This is why I came up with $2, because I kind of by eye know the Fibonacci range. You could kind of get the big sell-off. It comes back into this Fibonacci region, and then it starts to just chop back and forth and just become messy. And it's the people chasing the return to the old high, pushes it back up to a good level, but then it just doesn't recapture the magic that was in play earlier on. So I wouldn't play this one, even though there's upside potential. It doesn't really stack up when I look at what's my risk to go for that. What I think could happen that does stall and then not do much for a while. So I'd be inclined to leave it.
All right. CHN.
So well, this has the makings of something. So we've gone from below to above the averages, initial pullback to the averages, and the averages are close to crossing. So and this all ties into that, that lithium space that we're looking at and we're talking about earlier on. I think it's a lithium miner, a Chalice, but the lithium rare earth space thereabouts is in there, and that's an active area at the moment. The structure isn't quite there for me at the moment. I do wait for the averages to cross, and then often you get an initial run above the average and you get some work, and then maybe you get a secondary breakout. That's probably where I would be. It's not to say that has to happen. It could continue shooting higher from current levels, or it may just stall and fizzle again. And maybe it's a case that just bounces along the bottom for months to come. So we never know. But as I keep coming back to, we don't need to know. We just need to have parameters that we can work with. So if someone likes this, if they bought at current levels, maybe they could have a stop below the 100-day moving average. Maybe you're looking at around 26, 28%. So it's getting towards a pretty decent, it's getting us towards a sizable stop loss. And there's no guarantee that this stock could pull back. From current levels, it could pull back to around that 28% and then just sort of track sideways while the moving averages stabilize and then break higher. So it's not a clear-cut play at the moment, like we went through with Lark, where we could sort of see, look, we've got a pattern we can work with. We've got lows which aren't too far away we can work with. This one doesn't give us neat parameters at the moment. There's certainly some upside potential with it. Look, if someone really liked it, it could be bought at current levels, and I think it probably needs a stop loss of at least 25%. Maybe that would. Yeah, look, it could be bought at current levels, stop loss 25% lower. I think it works out. It does have the upside potential to support it. The alternative is see whether we get a consolidation into the moving averages and then buy a breakout or the pullback to the averages if it's looking corrective. So, but definitely an interesting one to watch.
All right, we've got quite a few here to go, Jace, so just be mindful. TRJ.
Okay, so I'll move a bit quickly now. TRJ, this was a motion trader signal through the week. It might have been a couple of days ago. Interesting. Look this. So we've gone from below the averages to above, and there's that sideways consolidation that I like to look for into the moving averages. See where it's come from. It's come from great heights, crashed out. There's no idea what they do, but I like the structure. Although it's thinly traded. I looked at this the other day when it turned up in the motion trader signals. So that's the risk with it. It's also got that same ascending triangle we talked about with Lark that's just broken higher from. So it could be bought at current levels, stop below the moving averages or the motion trader stop, which either one. It's a stock which it's got the setup to potentially deliver. Well, let's see whether it delivers. We never know, but we just want to play the ones which could deliver, and some of them will, some of them won't. We just move those ones on without too much damage and let the ones that work do all they can.
All right. WPL.
WPL.
WPL, it could be that US stock at the top. Is that a US stock at the top?
Yeah, I'm wondering. It's Woodside's old code. I wonder whether it's Woodside. I don't think it'd be that. That is a futures contract. So look, let's just assume it's Woodside because Woodside's old ticker. Woodside for me is still a no because we still have these declining moving averages and the trend is still down. I'm sure it will bottom at some point, but we just don't know where that bottom will be. Oil's still in has a vulnerable setup. So the likes of Santos and Woodside, I'd be inclined just to leave alone at this point. I don't want to try and punt the low. People who have punted lows previously are now maybe they're holding on to stock which is worth less than they bought it. So rather than try and get the low, I'll let it stabilize. Ultimately, it'll get above its averages, and then maybe we get a setup then. But for now, I'd just leave it to the side.
All right. AFG.
It's it's just a bit range bound at the moment. We can actually draw some parameters around. So we've got some clear levels to work with, which is great. So we've got this compression range. The price continues to compress within the range. Moving averages are largely, moving average. Let's say they're going sideways, and price is oscillating either side of the range. It was probably enough to trigger a motion trader signal a few days ago because we did have the rising moving averages, and we do have rising moving averages at the moment. And price was breaking to a 70-day high. So that's my basic criteria which I look at. When I combine it with other things, I come and I look at the individual chart. That's when I see that's still within this broader range. So it could go from here. or it could continue to move sideways. But it's one to watch, and I like that the levels are clear. So we start getting above the September high, start getting up to around high 170s, and you're going to be probably saying, look, we're getting a breakout from this range. It could be a building, it could be a basing period that leads to higher levels. The risk around it is probably like, stop loss is probably back down around $1.40-ish. But yeah, this is one which could move higher, but at this point, it's not quite there when I look at it from an overall chart perspective and just looking at a little bit more other than just where it is to the moving averages. When I can see that range, it is still within that range.
All right, let's get on to look. Just as an FYI, we probably, if you're putting them in now, Tiggers, we probably won't get to them. So probably just do about 4 or 5 more. But let's start with SCU6.
What was that code again?
Right, just CU6. Just CU6.
Yeah. Trends in place. I've got this. I've been holding it myself for some time. And this is why we let profits run. We don't use targets, and we don't jump off big trends. I did scale out of this one a little bit. I sold a third just when we had that market turmoil about 8 weeks ago. I de-risked my portfolio. This was becoming a larger weighting within the portfolio. So I did skim some off the top. I don't mind doing that occasionally. I generally don't do it. I've only done it a few times in the last 10 years, but occasionally I'll skim some off the top. So I did that with this, but for the balance, I'm just letting that run, and the trailing stop is below the 100-day moving average, giving it lots of room to move. I'd struggle to buy it at current levels, but I'm certainly happy to let it run.
All right, SXE.
Trend remains up. We do have this little consolidation going on at the moment. If I had it, I'd continue holding it. I probably wouldn't buy it because the moving averages do have a little bit of a roll to them. So it's some of that momentum's coming out of it. So I'd let the profit run. My stop loss is going to be back below the 100-day moving average. It's going to give plenty of room to move around. Maybe it breaks to the top side, but it could also break to the low side of this pattern. So that's why I want to know where my exit point is. But at this point, I'd be letting it run, but I wouldn't be in a hurry to be buying any just at the moment while we have this sideways and these moving averages, which do have a little bit of an arc to them.
Okay. LNAS. N for Nelly.
What does this one do? Globex. Don't know.
Yeah, look what it does.
Doesn't really matter from the chart perspective. It's just interesting sometimes because I can see
ultra long NASDAQ 100 complex ETF.
Yeah. Well, I'd just be careful with this one at the moment. It doesn't have a structure which I'm really keen on. The moving averages are to the downside. It's coming back above the averages, but it's not nice and clean. I'd be inclined to leave it. Just got to be careful with these leveraged ETFs. It's great when the trend's in play, but NASDAQ's not trending so well at the moment. Out of all the US indices, the NASDAQ's now the weak one and hasn't made a new high. The S&P has, Dow has, Equal Weight has, NASDAQ hasn't. And it's, of course, influenced by some of those really big cap stocks. Chances are, look, if this overall upward trend continues, NASDAQ probably does make a new high. but that ETF didn't look particularly where I was overly keen to be at the moment. I don't know. I'd leave a leveraged NASDAQ ETF alone until we start getting some good momentum. Of course, it means you pay more for it, but we're managing. We've got to think, what's my risk? Well, I'm always keep coming back to the risk. If the upside just looks a little bit clouded, and I got the risk there, I'd probably be inclined to just step away and look at something else.
It's a really difficult chart to look at, that one as well. IPG.
Yeah, trend here is still up. I've got this consolidation. You see this little consolidation pattern. So I like the rally we had off the June low. We've got a sideways consolidation. We've got a rally off the moving averages. Got another consolidation. If I'm in this stock, I actually think I am in this stock. I think it's one of the ones I have. I'll continue holding it because we've got this general upward momentum. We've got these rising lows. We've got higher highs. I'd be staying in. I think the path of least resistance is to the upside. And if we get a break, maybe we get a break above the 13 June high. Maybe that'd be a situation to add to a position or initiate a position. Also possible to buy a position at current levels. Like it is like moving sideways towards the moving averages, and then it's kind of looking at maybe it's a 10% stop loss sort of thing. Below, just getting nicely below the 100-day moving averages, and I'm using this low point from where's that, late August as just another point getting beneath that. So yeah, upside potential in this one still.
All right, let's have a look at Zip. I missed that one before. Zip up 911%.
Yeah, well, if you pick the right low, you can do really well. Easier said than done though. If I had it though, I'd continue holding it. Trend is clearly up. Got these rising moving averages. Is getting a bit stretched from the moving averages. Maybe there's some consolidation. Let's the averages catch up. Tricky one to buy at the moment because it requires a bit of a stop loss. Even just coming back to the September low is probably looking at like high 20%. So I'm probably not a buyer at this point. Although, if I got in on some of these, like there's some nice patterns to get in on this one. Like there's your classic consolidation back to the averages and a breakout. If I was in on some of those, I'd be letting this run, but I'd be using a wide trailing stop. My trailing stop would be below the 100-day moving average because you can get volatility in this. Like just looking at this pullback, like there's a 33% pullback from the high. So I think it's hard to trade a stock like Zip if you're going to have a 10 or a 20% stop loss, because you're going to get these moves like we had earlier in the year, which 33% will take out most stops. An ATR-based wide trailing stop will probably see that off. But if you're using a fixed 20% or something, it ends a trade. So I'd probably be below the 100-day moving average with my trailing stop.
All right. CLG.
Unfortunately, this is a no, because we just got these declining moving averages and prices declining with them. Maybe this becomes something at some point, but it's just not there at the moment. And you can also see, just like you can see where prices broke down from. You can see it's traveling sideways, always vulnerable below the moving averages, and then we had the breakdown below support with those averages in reverse as well. It's for me, it's not the place to be.
All right. All right. There's a few down the bottom, but what we'll do is we'll look at the one that a few people are asking for, and I think LYC we've looked at. WDS, yes, we looked at that one. We'll just finish off on IGO. That'll make Jux and Shalini happy, and I think that will be a wrap for today.
So this is lithium. It's like for me, it's not there. The averages we're starting to get the 100 or the 50-day is starting to turn higher. The 100's flattened out. It's but for me, it's not quite there yet. And remember this. Just remember this. Like someone could have asked. We could have talked about this in early this year, and we got this sideways below the moving averages. Maybe there's a base forming. Maybe we're starting to get some upward momentum, but it hasn't broken out at this point. We could have drawn some parameters around the range to say, look, we've got some clear-cut levels to keep an eye on, but at this stage it's not quite there, and it broke down. So I know there's eagerness to get into some of these high potential stocks, but be careful because they might look like they're basing, but until they break higher and ideally have those rising moving averages, they can also turn lower. So I'm not quite ready with this one yet. At the moment, it's just had a rally back to the declining 100-day moving average. If someone wanted to punt the low, what are we looking at? Looking at 21% to punt the low. So I wouldn't do it, but at least we've got a parameter that we can use. We can say, look, okay. Someone might say, look, I'm happy to put 22% on this because I think it can double, and it probably can. It probably could double, could possibly more than double. So someone might say, look, that's a fair punt. I prefer putting the probability more on side with price being above those rising moving averages. But look, there's always different ways you can do it, as long as you can map out your parameters that your risk reward makes sense to the to the situation.
Okay, I think I just had a quick look at some of those other tickers, and they're very similar in nature. But I think we'll leave that. We'll call it a day there. I'm just going to finish off by saying, please, I love seeing the comments here. Saying thanks for us doing this show. It's really nice. Thanks, Neville. And thanks, Jennifer. It's great having those compliments there. Appreciate you guys coming. Please do like and subscribe and write any comments down below, and I'll be sure to read them. If you do want to hit up Jason, you can hit him over there at motiontrader.com.au. And if it's, for me, it's you can just send an email to support@selfwealth.com.au, and I'll be the one to respond to you there as well, right? So, thanks a lot, Jason. Thanks for another great day. I just want to quote here Makusa's the white rabbit means good luck to all. So good luck to all this week. All right.
Lovely.
You say that on the first day of the month. Sorry, you say that on the first day of the month.
What a good way to wrap up the show. So thank you very much for the white rabbit. And hopefully the show's been interesting. We've covered a lot of ground and a few ideas to have a think about.
Perfect. Thanks a lot.